Okay, we're about to
Not he either, it was the other fellow.
initiate the concluding session. Thank you all for your persistence. This is probably,
He
in
gave
the context
of money.
Ivan Minsky, the most interesting session we've got. Because as you know, as you probably would have imagined, if I were still alive after having seen this sustained period of relative calm and what looks like a return to what is supposed to be some sort of stable expansion at a constant growth rate, I would have started digging around to try and find out what was going to go wrong. So this afternoon we're going to dig around a little bit and try and figure out what is going to go wrong. And as you know, I would have been looking at balance sheets, and he would have been looking at layering and financing arrangements. And this is going to be what we're going to look at. We're fortunate in having two extremely inquisitive and well qualified investigators of these issues. Bob McCauley, who returns to the Minsky conference after 20 years? I say Bob McCauley in particular occupies a place in my heart very close to Minsky's, because he is the person who, if you remember Eurodollars back in the old days, there were people who had these ideas about Eurodollars floating all around Europe and having infinite multipliers and all sorts of things like that. And Bob McCauley, I think, was probably the only person who actually understood the actual balance sheet entries that took place with the creation and the destruction of Eurodollars, and explained this to me. And ever since that, I have been, what should I say, impressed by the need to look at the underlying, if you like, the underlying plumbing of the kinds of what we would now call financial innovations that we look at. Bob eventually started out at the research department in the New York Fed, eventually went to the Bank of International Settlements, opened the Asian office of the Bank for International Settlements, which occurred long before anybody was concerned about the Minsky moment in China, but was there to see it develop, and has now returned to the home base in Basel, where he continues to dig and investigate. He will be our first speaker. Frank Veneroso will be the second speaker. I should say Bob is going to look primarily on international indebtedness. Frank is going to look at domestic indebtedness and suggest that probably we have been missing some of the major changes in indebtedness in the U.S. economy over this period of quantitative easing, which has been in the economy. I won't bother to give Frank's background, which is varied. Frank, Frank set up a number of these financial institutions in his young age. He also was an expert on commodity markets before commodity markets became popular, and has gone on to build a career as an analyst of financial markets, and I won't say someone who admires Hai, but someone who recognized the importance of Hai for his own work, and has become quite an expert in Hai's writings, probably as much as anybody who is here in the building. So I'm very pleased to have two extremely excellent speakers for our afternoon session, and I'm happy to give the floor first to Bob McCauley.
Thank you, Jan, for that kind introduction. It has been 22 years since I've been here, and I thank you for the invitation to return. I learned my Minsky through Charlie Kindleberger around about 1977, 1978, when the Manias, Panics, and Crashes was at the publishers. And I consider myself a card-carrying Minsky-Kindleberger scholar. So it's a great privilege to be here. So my text for today is tracking dollar debt of borrowers outside the United States, and Jan has set a table for you here with two very complementary pieces of meat. You'll see. So I'm on the international side, and Frank will be on the domestic side. We'll be talking about borrowing over the last decade and its measurement. So my agenda is dollar debt outside the United States, its size, its growth, its composition, its funding, where it comes from. And I'll look at the maturity profile of the bonds that non-US residents have sold that are denominated in dollars. And I'll profile some individual countries, emerging market countries, and show you how different the composition of their debt is. And then I'll take a bit of a detour and talk about off-balance sheet dollar obligations. And the punchline there is they are more or less as big as the on-balance sheet obligations in dollars of non-US residents. So that's a kind of twofer point. And then at the end, I'll come to what the replacement of US dollar LIBOR by a domestic rate might imply for this offshore dollar debt. In a sentence, with the accident of LIBOR being a London rate, there's immediate interest of the US authorities in any disruptions to the global dollar funding markets, well demonstrated in 2008. And with the replacement of LIBOR, there's at least a question of whether disruptions to that market will have the same urgency to the US authorities as they have in the past. But let's go to the start here. So global dollar debt of the non-financial sector has two pieces. On the one side is the familiar set of numbers that you see when you open up the financial accounts of the United States. We used to call them the flow of funds, compiled by the Board of Governors in Washington. And you see here in gray, that's US government debt, including state and local. The reddish area there is private debt in the United States, household sector, corporate sector, non-financial, non-corporate sector, say the real estate business. And on top is the new bit that we introduced several years ago at the BIS, and now we regularly profile in what we call the global liquidity indicators. The blue area is non-resident, non-financial obligations in US dollars. So in the grand scheme of things, it's not huge in relation to dollar debt. If you exclude the US government debt, then the offshore dollar debt, the dollar debt of non-US residents, is something like a quarter of the global total. So sizable. On the right-hand graph, you see the growth rates of these two aggregates. And the red line there shows the US flow of funds, X, the government sector, the growth of dollar credit in the United States year by year. And you see the dip in the recession and the subsequent very slow recovery of private debt in the United States, never really getting to 5% yet since the onset of the recovery. And you see the blue line there. The first thing that strikes you, of course, is how much more exaggerated the swings are in it. But if you focus on the time since 2008, 2009, I think what is most striking is the gap between the red line and the blue line. So as the Federal Reserve lowered interest rates and bought securities, increased the size of its balance sheet, the biggest response, you might say, came not where the response was hoped for or intended, but in the realm of the unintended consequences, borrowing in dollars outside the United States. And that shot up to very rapid rates in the immediate, at the beginning of the recovery, and since has come down, and actually showed a noticeable dip in 2015, 2016 that I would associate with the strength of the dollar from 2014, 2015. As long as the dollar is weak, as it was into 2011, it was still on a downtrend from 2002. As long as the dollar is on the weak side, those who have borrowed in dollars, those corporate treasurers who have taken the risk if they don't have dollar revenues of borrowing in dollars, they're heroes. Because as the dollar falls against their own numeraire currency, their liabilities are shrinking. Their equity is increasing. They've done well, and they do more of it. So the dollar exchange rate is a kind of enabling or even an encouraging factor. A weak dollar makes dollar borrowing more attractive. So when the dollar started really to rise in 2014, 2015, we had a slowdown, and when we get to the country evidence, you'll see some places where it happened in particular. So I hope you get the idea here. This is sort of the overview of the two presentations. The bit at home, the bit that the Fed has been tracking since the 1950s, and the piece that we have added, trying to match the concept of the non-financial sector. Now here I changed the sector focus a bit. I go to a broader concept, the non-banks. So the problem is we can't really do as good a job as the Federal Reserve does, because we have bank loans and we can choose whether they are to banks or other banks or to non-banks. So we can't really refine that down to the non-financial sector. With the securities bit, we can choose the sector more carefully. So this is a somewhat broader concept, the dollar debt of non-banks outside the United States. And the world here, our latest observation is $2 trillion of dollar debt outside the United States. And you see that that's divided into two pieces which have become roughly equal sized, thanks to the fast growth of the dollar bonds outstanding over the past 10 years. And the bottom bit is bank loans, and the top bit in blue is bonds issued by non-banks. So that's the first decomposition between instruments. And again, the point is that this has been a time of the capital markets, a time when banks that make dollar loans in many parts of the world have been restructuring, have been rebuilding their equity, have been, in some sense, struggling. And meanwhile, the securities markets, the bond market in particular, has taken off. And you see on the right-hand side the chunk of that is emerging markets. It's important to emphasize that the emerging markets, though we think about dollar debt in Mexico, Brazil, Argentina, 1982, we tend to think of dollar debt as being associated with emerging markets, but in fact, the bulk of it is with more advanced economies and parked in offshore centers. But again, we see that the more dynamic piece for the emerging markets has also been the bond market. Now, I would emphasize there's two margins of growth of dollar bonds outstanding. You might say there's the extensive margin. That is, new issuers welcome to the bond market in the past 5 or 8 years. Did you know that Rwanda had a dollar bond some years ago? Zambia had a dollar bond some years ago. A number of African countries with fairly short periods of time, since they were benefiting from debt forgiveness from official creditors, actually were able to come to the bond market, and Kenya, others. And so that's the extensive margin, the so-called frontier. I'll never forget the Mongolia underwriting the first time to the market, and they wanted to do $500 million. They got bids for $5 billion, 10 times as much as they wanted to issue. At $500 billion, that was 20% of Mongolian GDP. So if they'd taken all the money offered them, they could have probably broken a record by borrowing 200% of GDP in a single go. There was a certain tripping of feet as the portfolio managers running bond funds tried to diversify into the new extensive margin. But actually the intensive margin is where the real money is. And I'm not sure, but I think Petrobras might be the biggest borrower in dollars, certainly probably in the emerging markets at least. You'll recall that they found oil offshore in Brazil, deep under the ocean, deep under rock salt. And that was a good story. And of course, the political process starts spending the tax revenues before the first drop of oil is pumped. And so it wasn't just Petrobras, it was the Republic of Brazil as well. But the intensive margin probably bigger. So this I'm hook up with Frank's presentation. So you can think of the Fed doing quantitative easing, or more properly the large-scale asset purchase program, as an attempt to make conditions in the bond market easier for would-be borrowers. And why do that? Well, the hope would be that you would make it a little easier for households to do their mortgages. But you see there that the yellow line, the government-sponsored enterprises, that's the bonds of Fannie and Freddie, they were falling as recently as a couple of years ago. They're not falling. They were falling well into 2011, and they hadn't recovered to their point before the crisis until just a year or two ago. So yes, that was the Federal Reserve actually bought GSE, mortgage-backed securities, clear intention to get that market moving. And you see the response in the yellow line. The private asset-backed security market, the private label, sometimes called toxic assets, well, they just sort of ran off over time. You see the green line there. But you can see real success in the top two lines. There, the blue line, which is the U.S. non-financial corporations, and the hope there is with the Federal Reserve acquisition of bonds having pushed down the term premium, that long-term borrowing by the corporate sector would encourage them to finance more real capital expenditure. Well, they certainly sold a lot of bonds, and that's the blue line there. The change over time, over $2 trillion since the crisis. But at least through these observations, the still greater success was the unintended success of the bonds issued denominated in dollars by non-U.S. residents. So this wasn't on the Fed screen at all, I think I could say safely. And yet there was growth, and lots of it. The graph to the right is a kind of a rolling regression that suggests that the lower the term premium, that is the difference between expected short-term rates, say over a 10-year period, and the bond yield, that difference, the so-called term premium, the lower it was, the more compressed yields were relative to expected short rates, thanks to the Fed's buying of bonds, the greater was the issuance that goes into that red line. So, I've come to realize that at this point in the talk, many people will be wondering, well, wait a minute, where do these dollars come from? You know, the buck starts here. Presumably the buck stops here. Where's all this coming from? So I've put together this graphic, and we start with the United States. We draw a line around the US border. And we say they're banks and bond investors in the United States. And now we're going to relate their holdings of dollar claims on borrowers outside the United States to a residual. And we'll call that residual non-US holders of the same debt. So at the end of this slide, we'll have an answer to where the dollars come from. So remember I said 11.2 trillion, but the number at the end of 2016 was just 10.5 trillion. So that's the dollar credit sort of offshore to non-US residents that we want to now split between the bit held by American investors and banks and the bit held by the rest of the world banks. So banks in the US have over $1 trillion of claims on non-banks in the rest of the world. And bond investors, if you believe the survey that the Treasury and the Federal Reserve does every year of portfolio holdings in the United States, foreign securities, bond investors in the US hold about $1.5 trillion. Well, the answer is already pretty evident, but let's fill in the rest. Banks outside the United States hold almost 4 times as much as banks in the United States. And bond investors outside the United States hold more than twice what bond investors in the US hold. So we step back from this, and the conclusion is what's going on out there, what Jan told you he heard lo these many years ago. What's going on out there is not somehow that dollars are leaking out of the United States. The U.S. financial services industry is sort of single-handedly serving the rest of the world. No. It's actually dollar intermediation that's outside the United States that features principally non-U.S. borrowers and non-U.S. creditors.
Just a clarification.
There's a question of clarification, please.
If Citibank London lends to a non-bank borrower, is that considered a bank outside the U.S. or is that considered a bank inside the U.S.?
Good question. And this is done on a strictly residence basis. So among the borrowers could be Exxon, Netherlands Antilles, and among the lenders could be Citibank. So with the securities, we can do the distinction between residence and nationality. And we'll see some of that in the individual country cases. But to get the currency of denomination in the bank debt, we have to go to so-called locational data, so we're operating strictly on a residence or balance of payments basis for this purpose. But sort of what, I mean, if the Treasury Fed survey is right, then the bond investors, that would be mostly U.S. Money managers and pensions and insurance companies, although any foreign insurance company, foreign-owned insurance company in the U.S. would be in there too. And I suppose you could look at PIMCO and say it's really owned by a German company. So you can think of it in a number of ways, but on this is strictly speaking on a residence basis. Thanks for the clarification. So this has been a boom time for bond issuance, and the one that comes to mind as an extreme case is after Brazil was having a bit of a hard time borrowing in 2014, their flagship borrower Petrobras was having a hard time getting its accounts certified by a leading accounting firm. Finally, there was a sign-off, and actually Petrobras sold a 100-year bond in 2015. It's still out there. So this was a time of great maturity extension. And here we go to the distinction that the question drew between the residence basis and the nationality basis. So let me make clear that the Petrobras case is one where the nationality is bigger then the Brazil case is one where nationality is sizably bigger than residence, because about all of the Petrobras paper is issued out of a Netherlands Antilles financing sub. So if you notice, the scales are 2 times, so the nationality is much, much bigger. So emerging markets have sort of half of their bonds, emerging market borrowers have half of their bonds issued through offshore entities. It makes it fairly tricky, because what can happen is the money goes from the Petrobras Netherlands Antilles back into Brazil as a direct investment flow. So if you just sort of naively look at the Brazilian capital account, you'll be confusing what is really a bond flow with all the rigidity that goes with a bond for a direct investment flow with all the presumed flexibility of being able to cut dividends and so on. So fairly well spaced out, some bunching in the near years, but also pretty well spaced out. Of course, the flip side of that is if you own these bonds through your ETF, if US dollar bond yields go up, all that extra maturity is going to bite you in the form of lost value as the duration takes its toll. So let me take you through some particular countries here, and let me emphasize at this point that we're not really looking at dollar debts, dollar external debts. We're looking at dollar debts. And so in a certain sense, we don't care where the dollar debts are. And if we start with China there, and you look at that red line, that shows you local loans in dollars. So we think of the Chinese financial system as rather closed, but in fact, they have quite a bit of foreign currency banking in China, more than the United States has, for that matter. And so what that red line is loans booked at banks in China denominated in US dollars. Much of it funded, I might say, with deposits or other liabilities denominated in dollars of the same banks in China. So this is, from the US standpoint, not only offshore intermediation, but it's offshore intermediation sort of within a particular country. That's the red line. The reddish area is bank loans, and then above that is bond issuance, and we break it into 2 bits. The blue is the onshore, and the yellow is the offshore. So what the size of that yellow tells you is that when a Chinese real estate company goes out and sells a dollar bond, it's typically going to do so through a Hong Kong sub or a Caribbean sub, and then funnel the money back. And so actually most of the bonds of Chinese borrowers are issued out of offshore, and might show up again as direct investment flows vis-a-vis China. Again, the caution against using balance of payments data without too much care. So you see rises in these dollar amounts. The scales, I warn you, are different. The China is the big one. That's $1 trillion more or less in the last observation out of our, remember, 11.2 trillion. So China is not the smallest country. Brazil, I've already stressed the size of the yellow. Turns out the blue is pretty big too. Not so much dollar banking within Brazil there. More dollar banking, relatively speaking, down in Turkey. So the banks in Turkey borrow dollars from abroad or sell bonds in dollars and then lend locally to the corporate sector in Turkey in dollars. You see this propensity to use offshore vehicles for bond sales differs quite a bit. There are big yellow blotches there in Brazil, maybe Russia. Russia shows a sort of cliff, but what you have to understand is they started reporting to the BIS at that point, and so At that stage, we learned about all the dollar loans in Russia. So that red line only starts in Russia here when they started reporting to the BIS. And so that's a problem. If you're not a reporter to the BIS, we're hard pressed to know how much dollar lending there is within your economy at your own domestic banks. And it turns out Russia quite a lot. You can see, speaking casually, the effect of the sanctions if you sort of move up this bit here to match up with that series break. You've seen basically a decline, a runoff in both the bonds outstanding of Russian obligors denominated in dollars and as well as the bank loans. Let me go back to China. Remember when we were looking at the aggregate, we saw a kind of a dip of dollar, the aggregate dollar borrowing that happened 2014, 2015. And China is a good part of that. And basically, the RMB had been appreciating up until January of 2014, if memory serves, all the way from 8.28 up to 6 and change, 6.2 or something. And at that point, it started going the other way. Well, at that point, the treasurers of Chinese companies realized it wasn't so clever to be sitting on US dollar liabilities, and they sort of went into reverse, and you see a sizable decline, hundreds of billions of decline in the bank loans denominated in dollars to Chinese borrowers, and that is a good instance of how the dollar exchange rate sort of factors into the willingness or the desire to hold dollar debt. My colleague Hyun Shin thinks of the dollar's exchange rate as sort of an indicator of the global ease of financing. So in his view, when the dollar is weak, as it was, say, in 2017, that makes it easy for everybody because there's this $11 trillion of US debt out there, and all of a sudden, even if it's not matched up well against cash flows or assets, all of a sudden you're looking clever because your liabilities are depreciating against your base currency. And so there was a puzzle last year that not only was financial conditions easing in the United States as the Fed raised interest rates because the stock market was going up and credit spreads were going down and the dollar was depreciating, but in a certain sense, financial conditions globally were easing because of the dollar's exchange rate. So now this slide is a sort of standalone slide, a bit of a parenthesis. So in the session title, I think we have this phrase, missing dollar debt, and that's actually in the title of a recent quarterly review piece by colleague Claudio Borio and Pat McGuire. I think Claudio wanted to call it hidden dollar debt, but that struck us as perhaps a little too much. So we ended up with missing dollar debt. And you may know that if you do a repo transaction, if you borrow money and give a security as a sort of temporary collateral, that stays on your balance sheet, that borrowing. But if you do the same thing in the foreign exchange market through so-called FX swaps, that goes off your balance sheet. You have cash for cash in the near leg, and then you owe in the forward leg. And so that's a very common financing arrangement where you take some spare cash in one currency and turn it for a little while into cash in a different currency. That does not go on the balance sheet. And so in that sense, you can talk to the accountants why. We did, and I'm still not sure why. But the total of that turns out to be 58 trillion, make sure I keep saying trillion, dollars at the end of 2016, 52 trillion of which has the US dollar on one side. Now a big chunk of that is sort of the interdealer market. You can think of banks dealing with each other in order to accommodate customers. So cast your eyes then on on the customer bit here. And what are all these swaps doing? Well, most of them are counterparties that are financial firms. And we think of that as the result of hedged cross-border investment in no small part. And in particular, if you are a Dutch pension fund, say, and you hold U.S. Treasury securities to diversify your portfolio, but you probably don't want to be long the dollar. You want to have that actually held in effect in euros. So you do a swap to produce the dollars in the first place, buy the U.S. Treasury, and then the second leg of the swap has you selling the dollars for euros at some later date. And so in that sense, you have a sort of synthetic euro security. And we think that you know the IMF measures $44 trillion of cross-border portfolio, both bonds and equity, and at a hedge ratio of almost 50%, probably higher for bonds and lower for equity. That 18.9 trillion is quite a plausible holding as a way of turning, say, U.S. dollar securities into euro or sterling or Swiss franc securities. So there's a lot of that. There's also longer-term currency swaps, and we associate those with companies issuing debt securities in one currency and really wanting the liability in another currency. So that can be a matchup. So that's on the financial side. So in insurance companies, pension funds holding foreign securities, but wanting domestic currency exposure. On the non-financial side, this is probably more familiar turf. There's a lot of FX forwards, and world trade on an annual basis is 21 trillion, and we see non-financial firms doing forwards to the extent of 5 trillion. So it's as if 3 months worth of imports and exports are hedged from one currency to another. That kind of gets you that plausible relationship. And similarly, non-financial firms can borrow in one bond market but really want liabilities in another currency, and that gets you this relationship there. But what's the upshot here? Well, the upshot, I think, the takeaway is something like 28 trillion of dollar swaps and currency swaps forwards outstanding, of which 22 trillion is dollar on one side. And so you think of sort of half of that, you think of most of that as non-residents of the U.S. owing dollars forward. Remember the Dutch pension fund, it holds a treasury security and contracts to pay dollars forward to hedge that back into euros. So we think of there being something like half of the 22 trillion in non-U.S. obligations to pay dollars on an off-balance sheet basis. So something like the same amount as the 11 trillion of identified on-balance sheet obligations to pay dollars. Now, a lot of these are very short-term, 3 months, even 1 month, weeks long. But all to say that what we measure on balance sheet, there's probably as much off-balance sheet obligations to pay by non-U.S. residents. So the dollar obligations to pay, if I may use that rather than debt, are probably twice as large as the on-balance sheet bit I was showing you before. So I hope I've sort of laid out in a vaguely comprehensible fashion how much and who and how come. Now I want to talk about an issue, and we've just begun to publish, the New York Fed has just begun to publish a new floating rate actually an overnight rate for the US dollar. And that's called the Secured Overnight Financing Rate. They call it SOFR. well, it doesn't sound all that euphonious, but probably the first time people heard LIBOR, it didn't sound all that good either, but we've learned LIBOR. Now, what difference could it make? So you'll know vaguely that there was a scandal with self-serving quotes being submitted by banks and people paying each other bottles of champagne to shave their quotes one way or the other. And some people were in jail and others might be going to jail, and maybe did we get very far up the ranks in the banks? You can discuss that. But anyway, LIBOR, it has been decided, is a no good nick. It's got to go. And so there's a candidate to replace it, that's the SOFR, in some fashion or other. That's supposed to happen over the next several years. Now the SOFR is not like, so LIBOR as a historical accident is a London rate. So, but it didn't stop in London, because when you go for a floating rate mortgage in the United States, guess what you're looking at? You're looking at LIBOR plus. You see some floating rate mortgage holders in the room nodding sagely, and perhaps you wondered, why in the hell LIBOR? Well, it's a historic accident. Let's leave it at that. And who else? U.S. companies, to the extent they used to have things called prime loans. Now prime is only for credit cards. So it's LIBOR plus in the corporate loan market. The bank makes you a loan in LIBOR. So it's very convenient, if not always upstanding rate, LIBOR. Now, that historical accident meant, if we go back in 2008, that as the Federal Reserve was lowering interest rates in late 2008, it was bringing the federal funds rate down. But at the same time, the turmoil in the global bank funding markets, not least in dollars, meant that LIBOR was not coming down, or even on some days going up. And so the Fed exercised this masterful control over the federal funds rate, the overnight rate that banks pay each other, but that sort of wasn't getting through. It wasn't getting through, and it was important that it get through to the people holding those floating rate mortgages, because many of them weren't doing all that well on the asset side, namely the house price was falling, so the least they could do is benefit from a lower LIBOR, but that wasn't happening. And so there was a huge international effort to bring down LIBOR. And the Fed, the New York Fed lent, Walker will correct me, lent hundreds of billions of dollars through the discount window auctions in New York, very heavily to non-US banks. And on top of that, extended swap lines and swap loans, essentially dollar loans to the Bank of England, the ECB, Swiss National Bank, Bank of Japan, and others to lend dollars to their banks. So it's like somebody took a hose at the back of the Fed and was spraying it at the foreign banks of the world through actually several different hoses in different directions. But the idea was to get the dollars there, and it was a successful effort in that it brought LIBOR down, and it made the transmission of the Federal Reserve's interest rate policy effective. So now,
I'm guessing it was 925 billion combined, so.
okay, so let's round and say the Fed put $1 trillion or $2 trillion into the effort to make sure that non-US banks had enough dollars so that the interest rates charged to Americans on their floating rate home loans and to US companies on their floating rate debt would appropriately track the Federal Reserve rates down. That's the fact from 2008. Now let's rerun that with the SOFR. The SOFR's got a lot of foreign bank reporters, but it's an overnight rate. It's a secured rate, mostly Treasury securities in a repo. It's going to be a lot more controllable for the Fed. I mean, we see variations in the repo rates at quarter ends, and we think that has to do with the particular incentives of non-US banks that are so-called window dressing, changing their borrowing and balance sheet size at the end of the quarter when they have to report or pay taxes or whatever. So it's not like that has no effect of foreign bank activity in it at all, or no foreign banks reporting. But it is, on current evidence, very close to what's called the overnight index swap is very close to the federal funds rate, this SOFR. So there won't be, if we imagine a world where the U.S. mortgages and floating rates are based off SOFR, and U.S. companies' floating rate debt is based off of SOFR, the Fed won't have that sort of problem that it had in 2008 of a big gap opening up. There's a sizable gap right now, by the way, but a big gap opened up then between the rate it controlled and the rate that mattered in all the loan contracts. So the question, and I really don't have an answer at this stage, is does that mean that the U.S. authorities can be a little more hands-offish, a little more slow to respond, a little more accepting of disturbances in the global dollar market? Does that mean that the immediate interest, not just some generalized, oh, we should have financial stability and it's kind of a shame that foreign banks can't get their hands on dollars, but a sort of immediate self-interest, oh my goodness, you know, the floating rate mortgages are repricing in the wrong way. So if that interest on the part of the U.S. authorities changes, does that in a certain sense leave the offshore dollar market less backed, less worried about, more on its own? And how will that play out? That's I hope I've given you enough information to realize there's a big blob of dollars out there, and enough of a perspective on the change in LIBOR, which is happening for a completely different reason from this, the bottles of champagne and all that. But how those two things, the connection between those two things is interesting, is important, and remains to be seen. Thank you.
I am tempted already to comment on, but I won't do that. I will pass directly to Frank.
We have a Minsky conference. I've been attending Minsky conferences since 1998. Maybe half of them. I did so because in my professional work, I wound up getting heavily involved in financial crises. It was a complete accident, actually. I didn't have any training in economics. I had a little bit of experience on Wall Street. And I was asked to advise a Latin American nation's finance minister on how to create a stock market. And so I had to learn. And in those days, there was almost no financial theory. There was efficient market theory and a bunch of things like that, which professors took seriously and which I knew were a lot of hokum. It had nothing to do with the real world. I came from the real world. I didn't know about academic things. And it was strange. We started to develop financial markets in emerging economies, and we'd start them up, and sooner rather than later, rather than them contributing to the efficiency of the economy, they would start to go haywire and off the rails. And there were no specialists in this business, and I wound up being asked to deal with these problems. So for about 15 years, I had a strange profession. I was an international civil servant that was asked to look at financial crises, bubbles, and debt crises in emerging economies. And being self-trained, I had to scour the world for whatever there was, and there was almost nothing. what there was in financial theory basically said these things couldn't happen. But there was one man who had a theory, had writings and a theory about why financial markets, all of their own, spin off into disequilibrium paths, and sometimes those disequilibrium paths go so far that they result in destructive outcomes. And his name was Hyman Minsky. And I dug up everything that Hy had written in the 60s and the early 70s, and I made photocopies with thermal photocopy paper, which darkened and curled on the edges. And I carried them around in my briefcase in the airplanes as I flew to Chile and Bahrain and Thailand and God knows where, and studied them. And then I met Hy in the mid-70s and once again in the late 70s in order to be able to pick his brain and try and understand better. So I've worked with Hy's work in a living kind of way all of my life. I don't have the firsthand knowledge of him that the fellows around here have, but I think I'm as steeped in what Hy thought as anyone. After Hy died, I called up the Minsky Institute and I said I wanted to talk about the bubble that was underway. And Randy had me speak to a group here about Hy's theories and this bubble that was occurring in the stock market. In the 2000 Minsky conference, I gave a blood-curdling presentation that we had the greatest stock market bubble in the history of the Western world, and that it was going to burst disastrously. My friend Byron Ween laughed at me and said, "We all know Frank's histrionics." And it did not go well with many of the establishment people. And of course, we had this 82% decline in the NASDAQ over the next 3 years. That was one kind of pathology in finance, bubbles. In 2008, I gave another presentation about how we had a debt crisis and that this would be the greatest debt crisis that the Western world had seen since the 1930s. It was another blood-curdling episode. It also had some people with disapproving looks. And we did have the worst financial crisis since the 30s. But that was a different kind of financial pathology. That was the creation of excessive debt to the point of systemic insolvency. Now, this Minsky conference and this whole Levy Institute is supposed to be about Hy's ideas. And Hy is the man in the post-war era that carried forward a tradition of endogenous financial instability in market economies. Leave a market to itself, it will not converge to an equilibrium. It will sooner or later step off onto a disequilibrium path. And sometimes that path will go so far that the outcome will be disastrous. In his first paper, in which I think he set out the financial instability hypothesis in maybe 1966 or 65, it was published again with a different title. It was called The Economics of Disaster. So there are two types of these pathologies. One is asset bubbles and they burst. The other one is credit excesses and they lead to crises. And they sometimes come together and they sometimes don't come together at all. When they come together, they are self-interacting and thereby reinforcing. The worst kind of financial crisis you can have is when you have both of the pathologies and they both go bust. So I called one of those pathologies and predicted that it would bust. And I called another one 7 years later or 8 years later that it would bust. And now where are we? We have both of them, in the United States at least. together. One of them is almost as bad as it has ever been in history. One episode short of a record. And the other one is the worst it has ever been in our history, and for all the countries of the world that count, it is the worst globally in history. We have both pathologies, new extremes, they come together. All of history tells us that the outcome is going to be disastrous. And looking at this crowd relative to all the 20 that I have been to over the last 20 years, no one gives a damn. Okay, so the first thing we have to do is to describe what the extremes are. High wasn't interested in stock market bubbles. The first time I ever met him, I talked crazily about stock market bubbles in history, and he looked at me with a big grin on his face and a lot of merriment in his eyes, and he didn't say much of anything, and I felt that this was a man who had great mirth at this young fellow who was going on about something that really wasn't all that important. And Esther tells me that her recollection of all those 40-some years with High is that, in fact, that sort of was his attitude. So I'll start with the credit excesses, which was what High was really about in the United States today and only a little bit in the world. And then I'll go on to the stock market excesses that don't really exist in the world but exist in the United States. And I won't try and tie it into what Robert has said, though I'm sure that there's a tie in here because I still don't understand all of this very well. Okay, so let me go through this. This is a slightly different. Liz, how do I make it go? What? Oh.
I did it for you.
Oh, she did.
I did it.
All right. Okay. So let me tell you how we came about to recognizing that we have this great debt excess. Minsky had an idea about financial dynamics in history, which I won't get around to later. A profound idea. Came later in his life and has not been that much associated with his work. But basically, he felt that if there was a financial fragility and a financial crisis erupted, and it threatened to go into a debt deflation spiral, that if there was a bailout, and the bailout was successful, it would change people's behavior. They would realize there was a bailout. They would realize that intervention by the government meant there was less risk. And if people perceived that there was less risk, it would lead to greater portfolio plunging in the next cycle than it happened in the prior cycle. And so therefore, you would ratchet up capital asset price valuations and the levels of indebtedness. Okay, so this is what happened. He described it in Stabilizing through the 1982 episode. And then, of course, it occurred to a greater degree in 1989, 90, 91. And then we had a crisis, and then it happened again. And then at the end of the 1990s, we had a super bubble, and then that burst. And then we had in the 2000s every kind of bubble: housing, stocks, commodities, and a rise in private indebtedness far beyond anything that had happened before. And that led to the Great Crisis. But the bailout was by far the biggest bailout ever. And Andy Felderson and the crowd here put together this paper on what the gross financing was to bail the system out. And it was this unimaginable number of 29 trillion, a great deal of which was refinancing, but really it was just a bailout beyond anyone's imagination. I would have said that should have affected people's psychology. They should have gone back into portfolio plunging. We should have had a greater financial fragility at this time around, particularly since the bailout never ended. We wound up with year after year after year of NIRP, ZIRP, and QE, and so forth, to this very day. But we didn't see it in the data, at least the debt data. And then, at the end of 2015, Mark and I, because we write about this stuff all the time, thinking that private debt in the United States, which had peaked out at 164% of GDP, an all-time high, and led to the Great Crisis, that it was now only 146%, that we had deleveraging, that macroprudential regulation had contained the beast, and so therefore we would be on a stable path. And we then ran into this chart. And this chart came out of a French investment bank, and it was based on balance sheets aggregated for the S&P 1500, and it said, oh no, corporate debt was going to the moon. But that's not what the Federal Reserve for all funds data said. So we started to look for more data. And in what I sent you, we go through each aggregate balance sheet that we found, 5 of them. They have different numbers of companies. They cover different parts of the aggregate balance sheet. They're 20%, to 30%, to 40%, to 50% of the US non-financial corporate sector. Maybe one of them has the non-corporate business sector, but they all tell the same story. They all say that since 2007, corporate debt in the United States has doubled, and the Fed's data tells us it's only up by 33%. Now that is a gigantic discrepancy. Okay, so this is here our aggregates, the percentage change in non-financial corporate debt, depending upon the samples, and that's the Federal Reserve's numbers for corporations and for all business, including corporations. So that's the discrepancy. We know enough now about our aggregates. We have enough of them. They are not all the same samples. We have different wide swaths that have been cut across the corporate world's financials. We are sure the average of these is the right number. So as a result, the Federal Reserve doesn't know it, but there has been a doubling in corporate debt. And if you take, let's go to the next one, that doubling in corporate debt, and there are two worlds, huh? There's the corporate world and there's the non-corporate business world. We have less data on the non-corporate business world. We don't know exactly how to estimate that, but we can make a couple of assumptions. And we'll make the assumptions. What turns out is that the private debt to GDP ratio, if we were to make it 100% growth in non-corporates as well as corporates, gives you this ratio for private debt to GDP. That assumes that the government's debt data on household debt is correct. Okay, that assumes that it's correct. Now, maybe the corporate business sector hasn't leveraged as much. We have reasons to think that's the case. So we think that the private debt to GDP ratio, which peaked at 164, which the Fed says is 149, is in fact somewhere between 180 and 200%. Okay, now I have to go to the next one.
No, it's the one before.
Okay. All right, so we have a bunch of estimates based on which samples we use and what we think about the non-corporate business sector. And what we see is this is the green is the 1920s, and we had a big build-up in our private indebtedness, and that's basically what set us up for the 3 banking crises that turned a recession into a 4-year depression. And then we had huge deleveraging that followed that because of the wartime inflation and very rapid growth. So in the early post-war period, we had low indebtedness. When we got to 122% on this ratio in the United States by 1990, we wound up with the savings and loan crisis, the banking crisis, took out lots and lots of institutions. There was a very big bailout. Then we had some brief period of deleveraging, and now we've come into the current period. And so we went to 165% in 2007. That set us up for the worst financial crisis in 3 generations, and now we're at higher levels. So based on these numbers, history tells us we're going to have another financial crisis in the United States. Okay. All right. History has something very interesting to tell us here. For all kinds of countries, for many decades past, whenever the private debt to GDP ratio approaches or exceeds 160%, regardless of what the interest burden is, a financial crisis follows. Happened in the 1920s, but it happened to all these countries that then went into financial crises. So you could see that Sweden and Finland, for example, at the end of the 1980s went to 160% plus, and they had a financial crisis. Of course, Japan went to way above 160%, but it eventually had a huge financial crisis. Korea, in the middle of the 1990s, went to 170%, and it had a huge financial crisis. It turns out that this is a red alert threshold, 160%. We went above it in 2007, and we had the worst financial crisis since the Great Depression, and now we are above it in the United States. Now, the response that most people give us to this is, oh yes, the debts are higher, but the interest charges are less. And what really matters to financial crisis is debt service capability, not the level of debt. So by dropping the interest rate on the loans of firms in half, or the loans of households as well in half, we have improved debt service capability, so there's no risk of financial crisis. But it turns out we have data on the interest coverage ratio, and if the interest rate has come down and profits have stayed the same as a percentage of GDP or went higher, the interest coverage ratio should have improved massively, and so therefore the risk of financial crisis should be less. But in fact, the interest coverage ratios have not improved massively, cyclically adjusted relative to late in the cycle, 2007, they have gotten worse. But there's only one way that can happen, and that is if the level of corporate indebtedness hasn't gone up by 33% the way the government says, equal to the growth in GDP, but has doubled. And if that happens, then yes, the debt growth outweighs the decline in the interest cost, and the interest coverage ratio deteriorates. Now there's a related ratio, which is the zombie ratio. And there are many zombie ratios, but the basic idea is this. A zombie is a company that has an interest coverage ratio of less than 1. It doesn't have the EBIT to pay its interest. And so what is the percentage of zombies out of all corporations? If debt service became easier because interest charges fell, the number of zombies should fall. But in fact, what has happened is the percent of zombies of all companies has gone up. Now, some of them show, relative to late 2000 to 2007, that the ratio of zombies has gone up by a little bit, and some of them show that it's gone up huge. And the definitions differ, and the coverage of the number of companies differ, and we don't want to go into the details. This is the one that looks the worst. And here is I guess, BIS, Claudio Borio, with zombie ratio for many countries, and it looks the same. Maybe not as steep as the last one I showed you, but the percentage of firms that are zombies is risen relative to before the Great Crisis. Here's an interesting chart. This is a chart of the percentage of American public companies, 3,472 of them, that have losses based on GAAP. Losses, which means, of course, they don't have the EBIT to pay their interest. This ratio in the United States for all companies was 10% in the 1960s. It's now 50%. It has been 50% in the last 20 years when profits fell in recessions. Profits now are supposed to be at a new smooth cyclical high. And still, it turns out that the percentage of all companies that have losses based on GAAP is 50%. And if you go to science and you go to tech, it's 70%. I mean, you want Ponzi nation? This is Ponzi nation. Okay, why is indebtedness risen so much? We all know that investment as a share of GDP is less. You see it here. You all talked yesterday about this problem of corporations not investing, but engaging in Zytec, financial engineering, buying in their own shares. Yes, that is what they do with their financial resources. This is net equity issuance going all the way back to 1951. Firms used to issue equity to raise money to invest. Starting in 1984, they began to buy in equity with their financial resources. They have done it to an increasing degree on a smooth basis. In this cycle, it has been very high and very, very sustained. If you take a look at their profit to GDP ratio, which isn't in this particular PowerPoint, it's in your other PowerPoint, for non-financial corps, what you will see is that the profit rate has not risen. Yes, there's an investment rate. Yes, there's a cash dividend payment. There is no or not significant excess internal cash generation to buy in stock after investment, even at a lower rate, and cash dividend payments, so they have to borrow. And they have to borrow something like 3 or 4% of GDP every year. And if you sum up all of those borrowings in order to be able to buy in all that stock, you start to generate the debt buildup that we see in the corporate debt data that we have, but not that the Fed has. So that is what is driving our indebtedness. Now let's talk about the stock market that Hai was less interested in. I said to you that the stock market is also in a pathological state. Now this is the Shiller Cape, which smooths the PE based on S&P GAAP earnings. There is another alternative measure of earnings, which is called non-GAAP, and there is a favorite called IBES, and they used to be the same in the 80s, and then the non-GAAP numbers were 3% higher on profits than the GAAP numbers in the 90s, and then it was 9% higher in the first decade of the 2000s, and now it's 30% higher. And these IBES earnings are fictional earnings. They are not real earnings. They are the earnings that companies want to get their stocks higher, that brokers want in order to get stocks higher and churn them so they can make more in the way of fees, that money managers want higher so that their assets under management and therefore their fees are higher, that investment bankers want also to have so that they can engage in more of their operations. It's a happy conspiracy of all the players in today's modern financial markets in order to be able to pump up stocks and generate more fees. They're fictional earnings. We only look at GAAP earnings. If you take GAAP earnings and you smooth them, inflation adjust them, which is what Bob Schiller does, you can see that this is the third highest PE ratio in our history. But smoothing creates distortions. So if we look at them individually, what you see here, the blue line, which is 1929, the peak is 20 times. And that was supposedly a great bubble. The next quasi-bubble or bubble is 1961. And here it's 22.5 times. And in 1987, we took off. And it went to 21 point something times. And in 2000, we had our super bubble, and it went to 33 times. And in 2007, we went to 25, and that doesn't look right to me. And in oh, I'm sorry. Okay, so you got to look at this date before the stock market went down and profits collapsed. Okay, so it's 20 times, and now we're at 25 times, 26 times. So based on trailing 12-month GAAP earnings, this is the second. Ooh, sorry. Okay, 24 times. Okay, so this is the second highest PE ratio on record on peak earnings. So indebtedness is off the charts, record highs, United States, globally. It's a pathology, an extreme pathology. It's always been accompanied by a financial crisis or followed by a financial crisis. We have the second highest PE ratio, condition of overvaluation in the US economy. Of the five I mentioned, there has always been a crash. In two cases, there was no recession. Then the market crashes were 45% and 28%. In the other three cases, there was a recession. In those cases, the market declines were 81%, 57%, and 50%. So history tells us that we're going to have a credit crisis, a financial crisis, when the next recession occurs. And when the next recession occurs, we're going to have more than a 50% decline in the stock market. And when you put the two of them together, you get a real witch's brew. A lot of interactions, a lot of amplification, a lot of intensification. It looked dangerous when I spoke here in 2000 about an asset bubble. It looked dangerous, asset bubble alone, when I talked about a credit excess. And there were asset bubbles, but they weren't quite as bad. And the credit excess wasn't quite as bad. Here we are today. The pathologies are more extreme. Put them all together, much, much more dangerous than they were before. We are 9 years into a business expansion. What precipitates the crisis is recession. Of the 32 business expansions since before the Civil War, this is the second longest. The clock cyclically is ticking. The hour is not far away. 1 year, maybe we go into record territory. 2 years, when it happens, the dual pathologies all of a sudden cause the world to come apart. That's where we stand right now. And look at the number of people we have in this room today at the Mincy conference. It's absolutely amazing to me. Okay. I could talk to you about where we're going. I don't know how much time I have, or whether anyone wants to hear how it's going to play out.
Preach, brother, preach.
Okay, let me say something about high. I sent you another paper. I have been writing about high and the economics of endogenous instability for many, many years. I never do anything with it. So this time, because we see this crisis ahead of us, we've decided we've got to write this stuff up in a final form. And in order to be able to understand the way it will play out, is we have to understand the economics of endogenous financial instability. And in the post-war period, High is the major thinker when it comes to this kind of theory. And so let me just very quickly say that there are two schools. There is a general equilibrium school that argues, let markets to themselves and they will converge on a stable equilibrium. We associate that with Leon Walras. It was picked up by Arrow and Samuelson in the post-war period, and it has now become the dominant school of economics in the world today. Before Arrow and Samuelson, there was a respectable, more than respectable, school of economics that believed in endogenous instability. Let markets to themselves, and they will go off the rails. The greatest European economist of the interwar period, Joseph Schumpeter, pioneered this kind of thinking with innovation by the entrepreneur and all of its amplifications as a way in which there is no stable equilibrium, and when the shifts occur, they go into overdrive, they go into overshoot, and this leads to asset inflation that is unwarranted and excessive levels of debt. And then in the down cycle, that has to be unwound. And so this is what gives you the great cycles that Schumpeter was so famous for. Irving Fisher thought the same thing. He thought that financing in the financial market, debt financing in the financial market, was more important than Schumpeter thought. He thought that debt financing by the household sector was more important than Schumpeter thought. And once the crash occurred, he went back in booms and depressions and tried to explain why it happened. And it happened because there was this huge rise in private indebtedness, which I showed you earlier in the 1920s, that created this financial instability, this debt disease. That when the downturn occurred and price deflation was set in, the real values of the debt got more and more swollen. They pressured more and more aggregate demand and asset prices, and you went into the positive feedback loop to the downside of Fisherian debt inflation, which High referred to again and again. And then there was Lord Keynes. Now, Lord Keynes didn't talk about excessive debt, which was High's thing. Even though High wrote a book about him, he really wasn't into High's thing. He was a stock market trader, and he was an immensely successful stock market trader. He went through massive ups and downs. It was in the very fabric of his being. And chapter 12 is about the endogenous instability that occurs in the stock market. And he thought that the endogenous instability in the stock market is what created the mispricing of capital assets through the equity market that led to overinvestment and underinvestment in the real economy. In all three cases, endogenous instability was crucial to their view of the economic world. In the case of Keynes and in the case of Fisher, the overshooting dynamic that is created by adaptive or extrapolative expectations whenever times get better and asset prices move are amplified by what we call today the principal agent problem. That market participants who are serving others who own assets will misserve them because of their quest for short-term fees for themselves at the expense of their principals. And in that process, all of these nefarious investment bankers and brokers and money managers and pool operators will somehow or other intensify the propensity for asset markets to go off the rails and for debt structures to become even more top-heavy. That was the theory of the greats, the giants that High stood on the shoulders of. In the post-war period with Arrow and Samuelson, this kind of economics was banished. It actually became illegal to talk about these things. If you wrote a paper this way, you would never get it published in a professional journal. High took the thinking of these three people and he put it together in his financial instability hypothesis in a rather mild and professional way in the first 20 years of his life, of his creative life. Okay. In the next 10 or 15 years, starting in the 1980s until his death, he picked up on two other things. These were behavioral features, behavioral changes, whereby people intensified these shifts away from equilibrium, both in asset markets and in terms of debt structures. One has to do with the principal agent problem. With securitization, he felt that the banker no longer had to treat the loan he made as though he owned it for keeps. He didn't have to live with it. It didn't matter if it didn't work out. All he cared about was the fee that he got by maximizing the amount of lending and maximizing the amount of trading. The money manager was in exactly the same position. The investment banker was in exactly the same position. So as a result, agency misbehavior with securitization, according to High, intensified under money management capitalism, starting in the 1980s with securitization, the propensity to pathological outcomes. And then he had another idea that he brought up in stabilizing. And that was that in the post-war period, to avoid Fisherian debt deflations, we would no longer allow deflation, so we would always have interventions to prevent recessions from becoming depressions, to prevent financial crises from going metastatic, to prevent financial crises from somehow or other creating something like, can it happen again? Another depression. But the economic agents understood that. I can remember High telling my friend and I, Millard Long, sometime around 1982, at the AEA, did you see what they did with the Franklin National Bank? Did you see what they did with Chrysler? Did you see what they did with Lockheed? Did you see what they did with the international banks and the third world debt crisis? Don't kid yourself. People notice. People learn. People will react. There will be more portfolio plunging. And he said that in stabilizing. So High updated the pre-war economics of financial instability with these two ideas, totally behavioral, okay? When you add those, you get a more powerful mechanism for asset overvaluation and a more powerful mechanism for excessive debt structures. So what has happened over all these decades? What has happened is that the original bubbles of 1929 and 1961, or quasi-bubbles, were driven very much by Schumpeterian dynamics. New innovations, a profit boom, an investment boom, contagion to the investment public, euphoric expectations, overshooting of markets, over borrowing by those who are euphoric against the new wonderful assets, and thereby excessive debt, financial fragility, and eventually financial crisis. But when we got to the 80s, and I must read Robert's book, because he apparently wrote a book, which I don't know about, which shows that when we had the rise in 1987 in the stock market, we didn't have any of these Schumpeterian ingredients. We had declining TFP, declining productivity. We had a declining profit rate. We had above average real interest rates. So how could it be that we had this quasi-bubble? And it was all about that chart that I showed you, where now companies are buying in their own debt. We now have securitization. We have money managers now become short-termists because they have liquid assets that they can now speculate with, that drives them to speculation. And then we had one other thing. We had derivatives, and we had a particular kind of financial innovation that allowed for what we call portfolio insurance, which added to the amplitude of the stock market rise. We didn't have a debt crisis yet, but we were making one. And then that occurred in 1990, and we had the S&L crisis and the banking crisis and what have you. I saw this new dynamic that would drive the modern instabilities and drive them to greater degrees. I'll leave out the 90s and I'll leave out the 2000s. What I can tell you about this cycle is there are no Schumpeterian dynamics. There is a collapse in TFB growth. There are no new innovations that really amount to much. Oh yes, girls can talk to each other on the goddamn Facebook, but this is not the essence of economic development, right? And all of this excess of indebtedness that we're seeing in this cycle, and all of this overvaluation that we're seeing in asset markets is due to, yes, low interest rates, but more so because of these misbehaviors. Agency misbehavior is greater than it has ever been. Moral hazard after the great bailout of 2008-9 is greater than it's ever been. That's why there's no feel of euphoria, but still we're going to these extremes of financial excess, to these points of financial pathology. Now there is a historical story here of immense size. I sensed that. He had a historical sense. He knew the 20s. He knew all the stages of capitalism going back into the 19th century. He watched the morphing of these stages. He had a sense of financial history, and it had an arrow to it. And what has now happened in the post-war period is that finance should be the handmaiden of enterprise. And we all believe that economic development, enterprise, our standard of living rises because of technological progress and because of investment that embodies that technological progress. And that the arrow is always rising, even if it's slowed down for a while now. We all believe in technological progress. We all believe that our economic welfare will rise and rise. Finance as the handmaiden of economic growth, as a service sector that facilitates, should be following the same trajectory. But finance is not following the same trajectory. Finance is going increasingly pathological. We only had 3 famous bubbles in the 2 centuries before the Industrial Revolution. The Tulipomania, the South Sea bubble, and John Law's Mississippi bubble. We had overvaluations and excessive indebtedness all through the 19th century. But they never became bubbles because we had too much cyclical instability in the capitalist economy. The only reason why we had high indebtedness was because we had deflations that raised the real value of the debt. Now we live in a world in which deflations are not allowed. But after a period of quiescence after the great crisis of the 1930s, where there was no financial instability began to crop up again in the 1970s. I saw a lot of it in the third world. We saw it with the LDC banking crisis. Then we saw it really blossom in Japan to an unimaginable degree. But it also happened in the United States with the savings and loan crisis. Then we went into the 1990s. Then we had the Asian crisis. And then we had the super bubble in the United States. Things seem to be getting worse. They seem to be occurring in more and more countries. Then we went into the 2000s. Then everything got bubbleized. Real estate, commodities, stocks, and indebtedness levels of all sectors started to rise to levels that we never saw before. And then we had the worst financial crisis. since the 1930s, and the second deepest stock market decline in our history. And now we have gone into this decade, and all of a sudden we see all these misbehaviors that High identified leading to pathologies that are more extreme than the pathologies that we've ever had in the past. Somehow or other, the arc of finance is dangerously bending down. Thank you.
Okay, have I still got mic runners or not? Red? Okay.
One is on electric.
Okay. Walker claims that he has to leave, so he can have the first shot.
Quick question, I just had a note from Bob McCauley saying, the yield curve, 2-year, 10-year yield curve spread fell to 42.6 basis points yesterday. It's not much different today, about 43.6, something like that. And the Fed's still talking rate increases. Is that possibly the event that will prick the bubble?
Well, all I can say is classically it always is. But when financial fragility has been extreme, independent of the interest rate, the pressures from the financial pathology starting to unwind causes the recessionary dynamics in and of themselves. And I could tell you about this after this now, but there are 2 cases where we had severe recessions from high levels of private debt. The central bank didn't cause it, the interest rate didn't cause it. One was 1937 in the United States, and the other one was the most interesting one of all, 2007 in Japan. And Japan's 9% decline in GDP, okay, was not caused by the global recession. The last thing to fall in Japan in 2008 was net trade. It happened somehow internally from low levels of investment. And so we have to realize that when you have financial pathologies, when you have these extremes, they have their own internal turning point dynamics. And they then can impinge on the real world independent of the interest rate. Now, the interest rate, if you push it up, can wind up being more destructive than normal because of this underlying fragility. So it'll be sort of hard to say what exactly caused it.
So the flattening the yield curve, I would warn you that we still have the Bank of Japan taking the 10-year rate at 0, and European Central Bank buying bonds.
He's not on his mic.
Buying bonds every day. So in this world, I think the interpretation of the U.S. 10-year rate is pretty tricky. On Frank's last point, I say we don't sit around and ask ourselves why a sort of tower of playing cards falls over.
Okay, can I have one over here on the corner and then one over here?
Listening to your presentation, it sounds very similar to other things I've heard from Stephen King. I don't know if you're familiar with him.
No.
And he's an Australian economist. He's kicked out of 2 different universities because of his views. But he has developed a model. He says there's no such thing as a stable equilibrium, and the economy is a complex system where private indebtedness tends to blow up the system. You have to watch that. So I'm hearing that in what you say. And also there's Richard Duncan, which is an ex-World Bank economist, and he said since, for quite some time, I think after we went off the gold standard, we stop being we're not no longer capitalism, but really a creditism is our system. We said we go into recession when if the growth of credit goes below, doesn't increase at least 2%, we go into recession. Because we're so hooked on driving the economy through credit. That is your comments on that.
Look, I just want to say this one thing about this. In a piece that Bob Solo wrote with Frank Hahn, a book, he says it in the introduction. What is interesting about economics are the pathological extremes. The Great Depressions, the super high inflations, and this is one of the real neoclassical economist founders, right, of Cambridge, talking in 1997. He says the problem with economics today is that not only do we not have an economics of this, but there's no legal way to talk about it, okay? Now, that really, I thought, was very profound. In the pre-war period, you read everyone. Everyone talks about it. They give it different kinds of weights. Sometimes they say, here is my economics, like, here's my economics, but we also know there's this credit cycle. We also know there's this instability of credit. It's not something that I write about, okay? The idea of an efficient market for Schumpeter or for Keynes or for Fisher, these were the great names, was an absurdity. I mean, come on, we know what Lord Keynes said. He went short a currency in his first foray in his speculation, and he got taken out. And he said that the market can be irrational longer than you can stay solvent, and he really meant irrational. I mean, we all knew that that's the way markets behaved in that pre-war era. It's just this scholasticism that's grown up in this post-war period that people don't talk about it. High was rooted in the history of economic thought and economic history. He thought about the stages of capitalism. He knew what the giants said, whose shoulders he said he stood on, okay? And so, to say these things, you shouldn't lose your professorship. I mean, they're just obvious things that have a great tradition in our intellectual heritage.
Okay, way over there and then over here. Pass it over when you finish.
I have a comment and an observation. One thing I'm concerned about, I actually have some students writing papers on this for their exam, and that's the issue of innovation. And so one of the questions I have for you is, do you think that the fact that a lot of portfolios are being driven by computers that are essentially not monitored, but which can still influence the market, will actually make the crisis worse? That's my first question. My second comment that I just thought was, in light of what you said that you might be interested in, is that every year the Federal Reserve Bank of New York has a conference where they explain to professors of macroeconomics what they're doing. And in 2014, I went to one of those conferences, and they made a presentation on their analysis of the 2008, 2009, 2010 financial crisis in the real estate market and all the rest of it. And I asked them as a question, I said, okay, if you saw exactly the same thing, sort of what you're saying, exactly the same thing again, what would you do? And they had no answer.
That's probably because legality prevents them from using a different model. And they make their policy choices based on their models. But on this other idea, whether or not computers are creating some kind of a financial fragility in asset markets. Look, I don't know what the answer to that is, but there are a whole bunch of people that are famous speculators, famous investors, like Icahn, okay, who keep warning us that the automaticity involved in this kind of portfolio management can create something that is not unlike what happened with portfolio insurance in 1987. They have a better instinct than I.
Which would, but under your scenario, would expand dramatically, it wouldn't be contained.
Well, in 1987, we didn't have such a debt excess. I mean, maybe the private debt to GDP ratio was 110 instead of 190%, okay? So therefore, there was less chance for propagation, and this time around, there would be more threat of propagation.
Right, that's what
I'm not sure the answer. I've heard people who are in the market say that the automated trading is kind of like leverage in its effect, but I'm not sure. There's certainly an illusion of liquidity that comes from some of the high frequency trading, sort of sunny day liquidity that disappears. But I guess we've certainly had sort of warnings with things in the foreign exchange market, in the bond market, in the equity market. But I think it's very hard to assess at this point the importance of that factor.
I come to this conference, and honestly, I didn't know who Mr. Minsky was. I always felt that coming with the 14th Amendment, the first section, that a person was not including a corporation. And I believe that the Southern Pacific Railroad case in 1886 was improperly given an executive summary by the clerk of the court. But nonetheless, coming forward to 1908, and Dr. Todd had confirmed that the need for emergencies was sort of overshadowing everything that we exist in right now. FDR in 1934, who never thought that what he did in 1933 with the Emergency Banking Relief Act could work, wrote a book called On Our Way. And he essentially refers to the Trading with the Enemy Act, which was a 1917 act, which anybody dealing with the Germans at that point was considered a foreign enemy, and therefore that was part of and parcel of the Emergency Banking Relief Act. So anybody using the banking system was considered a foreign enemy. Your whole discussion, and here I have a Bank for International Settlements person sort of answering my question of yesterday as to what created the euro, and that's the non-balance sheet swaps. So during the first Gulf War, and that's what created the euro. But my question to you is that I've been called a traitor by people high up in the World Bank for even considering that the currency reset could in fact include various polycentric inclusions of gold to help stabilize in this whole off-balance sheet problem and stabilizing the Federal Reserve Bank so it could actually survive. Now, my question to you is, do you, in your experience, see a solution? Because I personally believe we've got to stabilize the situation before we can get rid of the emergency, per se. And that I think the use of gold in selective ways to do it, and that Congress believes in its present legislation that we go back to a gold standard, 5404, which they finally got an executive summary of, that I believe that we should selectively use gold to stabilize this off-balance sheet to swap. And that I just wanted to get the discussion, because in 1930, when they set up the Bank of International Settlements, they never liked the Glass-Steagall. They never wanted to see Glass-Steagall, and that they did everything they could to get rid of it, and they finally got rid of it in 99. But that quarter of quadrillion, which evidently went to the off-balance sheet swaps, I thought it was combined and commingled with the Exchange Stabilization Fund. I'm just looking for solutions. I don't believe corporations are human. It could be compared the least. And I understand that Mussolini's way of looking, which was adopted by FDR, which he had expressed On Our Way, he was so happy that everything was working, right? So I was looking for solutions in your experience, which would maybe include gold. That's all.
Okay, good luck, guys.
I spent about 13 years as a policy advisor when I didn't know a damn thing. I've learned something since. I stick now just to forecasting and I don't make any policy advice.
The suggestion of a return to convertibility, I guess I was thinking, what are the enduring changes in central banking over the years? And it seems to me one of those is the shift from convertibility to fiat currencies. I doubt very much we go back. Another is the shift from private enterprise to a public entity to do central banking. A third is the centralization of clearing. And the fourth is the lender of last resort. So it's a shame Walker's gone. I don't think once that's discovered, that we'll undiscover it.
Thanks. Thorwald?
Thank you. I have a question for Robert. You seem to imply that the change from LIBOR to something else could, reduce the commitment of the Fed to backstop international dollar markets. And my first question is, or I have two sub-questions. One is, wouldn't the same problem arise in the swap market, where you have, companies and banks trying to offset their dollar exposure? And then my second question is, with this enormous creation of dollar liabilities in non-dollar countries, isn't that sort of strange that nobody stops it at one point and said, who is responsible? If the Fed is not responsible and don't want to backstop it, who should? Shouldn't somebody say that, you can't issue dollar loans if you're not backing it with real dollars? Thank you.
So the suggestion is that the U.S. authorities are less committed to a dollar backstop because of the change from the historic accident of LIBOR to the new benchmark, and I pose that really as a question, and what happens if I wouldn't say the Fed has a commitment to the dollar backstop. I think my interpretation was that the Fed has a commitment to making the U.S. dollar monetary transmission work, and the state of the global dollar funding market was deeply at stake, owing to this LIBOR device, and without that device, sort of how does the problem manifest itself, and what will the response be? I guess I don't think if suddenly all the non-U.S. banks are funding themselves at very high levels in the dollar relative to the U.S. policy rate, I don't think that they'll just accept that. So the LIBOR was a device to keep their margin more or less stable in the face of strains in the dollar funding market, and absent that device, it remains to be seen how they'll respond to a situation where suddenly their margins are squeezed by the fact that their marginal cost of dollars has gone up beyond the price they're charging many customers for dollars. So I don't think the problem is eliminated, I guess is the presumption of my question. The problem doesn't go away with the SOFR. It has to show up in some different way with posing its own problem. So your other question is sort of who is responsible, and it's sort of a free choice. When there was the discussion of whether countries were going to dollarize most of 20 years ago, there was sort of a clear answer that it's a sort of your nickel, you do it, and it's sort of not our dollar but your dollar and your problem. So I think it's natural that the Federal Reserve does not take responsibility as a general matter for the dollars that are created outside the United States by creditors outside the United States on behalf of debtors outside the United States. I think it's sort of unrealistic to think of the Fed wishing to underwrite that.
Or indeed any regulator. I mean, these are non-financial, non-U.S. corporations, and who can tell them, sorry, you can't allow your investment banker to issue on your behalf. I mean, basically, there's nobody there who has responsibility for this. One here and then.
It seems to me that there's a link between the two things that you guys are saying. On the one hand, you have a huge buildup in dollar-denominated debt outside of the United States. On the other hand, we're sort of being flung into a financial crisis in the United States. So, could we see, massive global crisis on the horizon where, imports in the United States plummet because we have another 2008 or Great Depression, and the debts that were built up in the foreign sector can't be serviced because there's no dollars there. There's no dollar income there.
Well, look, I don't know how to integrate numbers that we have found by adding up all these corporate balance sheets in America and the data on these dollar borrowings by non-U.S. residents that Robert and the team over in the BIS have come up with. I think there's an overlap, but I don't know his data well enough, and I have to think about it a lot more because I've sort of been, I knew I should have been reading these papers, and quite honestly I didn't.
I sent them to you.
But let me say something about contagion, okay? Not in this PowerPoint, because I shrank it down, but in the larger one that we sent you. We gave the current private debt to GDP ratios with a little more detail around the world as of now. And they're all up by a lot. Some are up hugely, like China. We know there was a lot of contagion that I think we still don't understand in 2007 to 2008. And I would assume that if there has been new highs in private indebtedness, private debt to GDP, in other economies, in addition to ours, that whenever the next recession occurs, those contagion mechanisms will come into play. And the higher the indebtedness is abroad, the worse it will be here by way of the contagion mechanisms. Okay? China's a very interesting one in this regard because it's a command economy, and though they have this very high level of quasi-private indebtedness, and it is still on a rising path, okay? Because they're a command economy, they will be able to avert, at least in the short run, the type of crisis dynamics that you would find in our country, okay? But it may turn out that in a global context, it'll be harder for them. And so therefore, under the contagion mechanisms, global contagion mechanisms, it may turn out that China there's a big buildup in indebtedness, and it's very high and probably unsustainable level of investment, will somehow or other have a big impact. They're not going to have a Minsky moment, like people say, but they may be subject to more unwind in a global event than if it is just contained within the command economy.
So, before I heard Frank, and I suppose the current interpretation of my colleagues, is that since the crisis 2007, 2008, there's been deleveraging in some of the countries that were sort of at the center of things. So our understanding was deleveraging here, household sector in particular, deleveraging in the UK economy, deleveraging in the Spanish economy, deleveraging in the Irish economy. So the places that were sort of on the front line, as it were, 8, 10 years ago, have sort of built up buffers or reduced their immediate vulnerability. But the interpretation is that the response by the countries in the front line to have very accommodating monetary policy for a very prolonged period, including the interventions in the bond market, that meant that the countries that weren't at the front line in the last crisis have had a very difficult time, very difficult choices between letting the exchange rate appreciate or following the leader. And we think there's a lot of follow the leader behavior. If you read the Norges Bank, the Norwegian Central Bank's communication on its monetary policy, it's most transparent. It says, here's what the ECB is doing, here's what we think the ECB is going to do, and here's what we're doing, expressed even as a spread against what the ECB is doing. And I think what the Norwegian central bankers tell you is happening in a lot of places, and we have some evidence to that effect. So we look across countries, and it's not an emerging, advanced sort of split. We see economies like Canada, like Sweden, like Switzerland, like Australia, and like China and some other countries where the debt buildup over the last 8 years has been very considerable. And our sort of threshold is not quite as easily communicated as Frank's. It's not the 165%. My colleagues take a sort of trend of the private debt to GDP and look at deviations from that. They call that the credit gap. But the credit gap for China, very wide by the standards of Japan in the 1980s, very wide by any standard at all. Now, actually, the good news is in the last year or two, that has actually narrowed a bit, but it's still at a very wide level, very many percentage points of GDP above the trend, which, by the way, had credit deepening over time. So it's not a static number, but for China, really an escalator. And so if the debt just stops growing, the thing narrows. So that's the sort of narrative that my colleagues have constructed on this, that the response to the last crisis creates policy dilemmas for those not in the middle of the crisis, that leads to outcomes that put a number of economies, advanced and emerging, into a situation that has a lot of resemblance to the look of things in the UK and the US in 2006. Now, if we add the notion that the debt buildup in the United States, the largest economy in the world, is been worse than the numbers that we have taken from the Fed, that obviously moves the whole story in the direction you're describing.
I must just add two things. I didn't go through the details on how the Fed's made the mistake. But basically, we think that they missed the debt growth that is placed through securitization, which is the great financial innovation of our time. And we think that it is possible, maybe more than possible, that the debt data for other countries, including the Eurozone, indebtedness levels, are understated because there is a similar error. Okay. Second point, BIS is basically taking a trend and it's evaluating the degree of fragility relative to a rising trend. What I told you was that because of these changes in behaviors, these misbehaviors, okay, on a growing scale, that the arc of finance has been turning perilously. That this rise in indebtedness is not a secular event. It's not a positive correlation to economic development. It is an ever greater shift towards pathological states. So therefore, to take the rising trend in indebtedness and asset valuations as the baseline to which you measure the deviation is a mistake. The trend is itself a path to pathology.
Okay, I'm going to abuse my position as chairman at this point and ask Bob a question that somebody here should have asked him, and I think he knows the answer to. And that is, if you have all of these non-US, non-financial corporations raising all of these dollars, what are they doing with them?
Well, one version of the question is, to what extent are they matching assets or matching cash flows, and to what extent are they taking speculative positions? Is a sort of question I think I would feel comfortable with. And the short answer to that is we don't know. And I guess we do know that some popular prejudices down that line are probably not well founded. So the oil business is certainly conducted in dollars. But does that mean that an oil company in an emerging market country is well counseled to do a lot of its borrowing in dollars? Well, you might ask the question, well, what happens to the oil price when the dollar strengthens against the euro? And the answer is, systematically, the oil price tends to be on the weak side when the dollar is on the strong side, which suggests that even though all the invoicing and all the trading in oil occurs in the dollar, that effectively a sort of basket of liabilities in major currencies might better match a set of oil revenues than the dollar, which admittedly does match it in terms of the immediate invoicing currency. So it's this question of match or mismatch it actually turns out not to be an accounting question, but really an economic question, the sort of thing you need a regression to approach rather than inspection of contracts or consultation with your lawyer. So I guess the general answer is you have a batch of liabilities and you mix and match. I certainly don't mean to leave you with the impression that the dollar share of liabilities of, say, the Chinese corporate sector is huge. It's not huge. The Chinese corporate sector has a very large debt, and so the $1 trillion, more or less, is not a double-digit percentage of Chinese corporate debt. My colleague Hyun Shin, along with Valerie Bruno, has done some work where they actually look at individual balance sheets of dollar borrowers, and what they find is that the dollar borrowing seems to go into cash holdings, and they can't really identify the currency of the cash holdings, but their hypothesis, at least, is that a lot of it is in effect a carry trade where dollars are borrowed in an environment where the dollar is expected to be weak or stable, and then put into higher yielding local currency cash or financial assets. some variety, so that there's a combination of an interest rate play and a currency play. Certainly, when you see the Chinese corporate sector unburden itself of a couple of $100 billion of dollar debt in the space of 18 to 24 months in a period when the dollar was rising, it doesn't give you doesn't convey the notion that this is a well-matched set of borrowing. And the fact that some of the most prominent names among the issuers of dollar securities from China are real estate companies in China. That certainly smells like non-traded goods to me. Smells like the sort of borrowing that you saw in Thailand in 1996, where people were developing shopping malls on the basis of dollar debt. So I'm sure there's a lot of matching of assets and matching of cash flows, but I'm also sure there's illusions about what really the effective currency denomination of cash flows and assets can be, and I'm sure there's a lot of just plain carry trades going on. I can't give you the
No, I just wanted to bring this point up, is that, as Hy would always say, for every asset there's a liability, and these guys have gone out and they've collected a whole bunch of dollars, and there's got to be something else they're doing with them besides putting them in a sock. Jorg.
According to Frank, we are observing, living through the greatest financial pathology, greatest buildup of financial fragility of all times. And this is partly due to the response to the last crisis, bailouts which encourage even more risk-taking. According to Bob's analysis, a good part of fragility may also exist in the form of dollar debts by non-residents in the rest of the world. And your chart also showed that, especially in the early years after the crisis, that debt grew very strongly, and you suggested that that was also related to policies in the advanced countries, QE. And that was also what your last remarks referred to, that before the crisis, emerging market economies were widely considered to be in a fairly safe position. They had built up more solid macroeconomic positions, and that also kind of made them more better target currencies for capital outflows and so on. So in a way, that's kind of painting the picture that we are seeing fragility moving from one area to the other. We had the emerging market crisis in the late 90s, early 2000s, and then they kind of turned defensive, and the instability built up at the core, in the US in particular. And kind of since the global financial crisis, it has once again moved the other way through QE, with fragility building up in developing countries. My chart that I showed earlier showed this too, that the current account positions of emerging market economies, developing countries at large, have again turned from surpluses prior to the crisis to significant deficits, at least in the aggregate. So on the one hand, we have monetary policy in the US, both in the form of bailouts and encouraging risk-taking in the US, but also internationally by encouraging capital flows, being very powerful in creating financial fragility. But then, of course, your other point raises the question, how do we deal with it when things go wrong? Now, you mentioned the change from LIBOR. I seem to remember that the Fed used two arguments to justify its international orientation. One was that because of LIBOR, the transmission of monetary policy in the US required those activities. The other argument was that instability in the rest of the world, if we let the global economy go deeper into recession, this would hit the US economy as well, which would be in conflict with meeting their mandate, which is price stability and full employment in the US. So there were those two arguments. Now you made the case that the one argument may be weakened because the LIBOR disconnect may go away. Now, I'm also worried about the second argument for political reasons. As I understand it, these swap arrangements are agreements among the central banks, and given the political climate, I'm wondering whether they may not be challenged. Is there political support for doing these kind of arrangements? And if not, it would kind of open up another kind of fragility in the sense that there is really no backstop out there. After the global crisis we saw, the global dollar gap was a shortage, the BIS I think called it, was a massive factor in transmitting the crisis. And it was absolutely fundamental that the Fed acted as lender of last resort. So if that is not going to happen, we would seem to have a very serious problem. You pose an easy question. Let me dispose of it quickly. No, I take your point. There's both the monetary transmission, which is heightened by the historic accidents of LIBOR, probably won't be completely absent whatever benchmark, and the instability in the rest of the world. And I guess one of our messages with the global dollar debt is that U.S. monetary policy has an immediate effect on the rest of the world, not just through the copycat behavior, not just through exchange rates, which are in typical macro models, but because the domain of the dollar is so much larger than the United States, short-term interest rate changes in the dollar have immediate effect on cash flows, interest burdens all around the world. And so you ask, is there less of a backstop? And I guess I would say, first of all, the dollar reserves in the rest of the world remain very, very large, something like $7 trillion still. So there's and you mentioned that emerging markets were thought to be more robust in the mid-2000s in part because of their reserve holdings. So that's certainly part of the backstop. Despite your allusion to politics, the swap lines among the major central banks are still there, and we had a demonstration of how large and for a time unlimited their use could be. I mean, if anything has happened since Charlie Kindleberger died that would really surprise him, I think it would be the idea that central banks would have unlimited swap lines. I mean, I don't think that thought ever entered his mind. And he looked for the swap lines as really as the device for the international lender of last resort, but I don't think ever imagined them. So we have the owned reserves, we have the swap lines still in existence, and with a demonstrated potency that was thoroughly unpredictable. If Dodd-Frank is in the title of this conference, we should recall that Dodd-Frank did place many restrictions on aiding particular firms, calling for the Secretary of Treasury to weigh in on decisions, but it didn't touch the swap lines, and so I don't exclude anything in the future, but I mean, just to record where we are now and where the post-crisis reform got us, we're at a point where the owned reserves and the swap lines are still very much there. Now, there was a
a marvelous piece in The Economist, October 2015, by their U.S. Sort of chief writer, Patrick Foulis, and he suggested that the backstop is more problematic, one, because the dollar debt has grown, offshore has grown so much since 2007, and secondly, that the who's who of the dollar borrowers outside has gone, in effect, from countries the U.S. is used to dealing with to countries that it is less used to dealing with. I put together a graph, I didn't show it, that actually shows the sort of what is the emerging market share of the dollar debt offshore on the presumption that the U.S. financial relations with the advanced economies, as you see with the outstanding swap lines, tends to be easier than possibly with the emerging markets. And the emerging market share has drifted up a bit to about a third, certainly not to unprecedented levels. So the idea that there's a huge wholesale change in the who's who of the dollar borrowing in the direction of some counterparties that are sort of more problematic in some sense, that's not borne out in the data. So, you know, the appeal the BIS makes to those issuing reserve currencies is not that they should add to their governing boards of representatives of the whole world, just because the rest of the world is busy borrowing the dollar, busy borrowing the euro. That's not the suggestion we've made. We have suggested that those running the major currencies should look at this from a standpoint of enlightened self-interest, and as your second channel suggested, to take into account the effect of your policies on the rest of the world, including through these stocks of liabilities, and in the recognition that these things can come back in your direction, so that it's not only the spillover, but the sort of the comeback that is to be thought of as policy is being made. And if you take my colleague Hyun Shin's view on sort of the dollar's exchange rate as perhaps what we used to think of the VIX as sort of the regulator of the risk appetite or risk taking globally, or an index of the ease of financial conditions, I suppose the suggestion is that when the dollar was rising in 14, 15, 16, things like the problems with the RMB exchange rate and all of that sort of trauma in August of 2015 and January of 2016, maybe that was not just a sort of exogenous sort of thing, but the sort of thing you might anticipate when the dollar is rising. And similarly, if 2017 and to date the dollar is on balance been on the weak side, then to understand that represents a sort of potential global financial easing that is really working against the grain of higher short-term interest rates in the U.S. That what the gradually rising Fed funds rate is doing might be being partly or wholly or even more than entirely taken away by the dollar's exchange rate. So and on the point of to return to the point of LIBOR, I guess if foreign banks in the United States, to return to sort of the U.S. immediate interest, if foreign banks in the U.S. have a sizable fraction of particularly commercial and industrial loans at floating rates, I guess that we'll learn how tightness in dollar funding markets will sort of immediately impact the U.S. macroeconomy. So if it doesn't happen through the device of LIBOR, perhaps we should think about what other channels it might take. It's hard to imagine banks taking
not paying attention to a big squeeze on their margins in U.S. dollar lending, including in the United States.
I should make a comment about this political issue, because it worries me a lot. We were lucky in terms of the bailout, because the head of the Federal Reserve was an unusual man. He basically was not a market fundamentalist. His paper in 1983 said that the Great Depression was caused in half by a failure of the intermediation process. The market forces didn't work. He changed his views, and he became more and more influenced by Irving Fisher's debt deflation of Great Depression's ideas with his financial accelerator. In 2002, he told us that if there was a problem, the central bank would use the printing press, when that was something that a central banker wasn't supposed to say. This was a man who knew that financial markets could go off the rails, and he was very, very disposed to be very activist, and he was operating within America that still viewed itself as the leader of world stability, that believed very much that we carried the banner of cooperation, and we've got a private equity man who's probably a market fundamentalist, GOP style, as the head of our central bank. It's a different animal with a different DNA. And we now have an administration that doesn't believe that the United States bears this responsibility of cooperation. We don't know what this Fed and what this administration would do if we had an international contagion, but it could be very different than the last time.
Given that we started half an hour early, I would take the prerogative of finishing half an hour early, thanking you all. And if you would all join me in thanking those people who have made this place responsible. First, our AV people, Jake and Paul. Elizabeth Dunn and Kathleen Mullally. I don't know what happened to Kathleen, but she's around someplace. She's responsible along with Liz for everything else. We would thank Dimitri, but he's not here yet. And I would like to thank you all for coming and remind you again of our master's program. If you know of anybody who is interested in learning about these things on a more sustained and deep basis, please will you indicate us to them. And then finally, I would like to thank my panelists. Kathleen, you missed your our panelists who have given so generously of their time, and to invite you to come back next year, hopefully, and hopefully we will be as interesting, and hopefully Frank will have been proven wrong by that time. Or else, if anybody's selling put options on the S&P, if you would step forward. Thank you very much.
I don't know if we've ever met. I've been reading your work for years.
I'm not sure either.
I really like your presentation.
Thank you, and I
Not
enjoyed
to
yours.
say
It was
it's the best one today.
You're going to teach training
Now I'm
the
going to
fall.
go.
Your stuff was
I'm going to go read your where do you based here in North? Yes. Wow. You ever get into New York City?
Well, yeah, sometimes.
You know? Yeah, no, I'd love to talk. I could learn a lot. But I'll write you an email.
Very good.
And if
You stay in touch.
things